Hello.
Hey, Mike, how are you?
Oh, let me turn up my volume here. Sorry. Hello.
How's it going?
Well, I apologize for being late. Let me shut my door. I was intensely focusing on the material for today,
Yeah,
and oops, we're late.
let me adjust my camera here.
So,
I'm a little
welcome
crooked
to
here.
Lumber from the Free Seats.
Yeah, kind of straight. Yeah, another, I'd like to say exciting week, but another lackluster week with lumber futures where, again, all the excitement seems to be all around us. But
Well, lumber was a leading indicator, or lumber futures was the leading indicator here, for sure in the market. Actually, I think Southern Yellow Pine was the leading indicator of
yeah,
this entire move.
yeah.
And futures chased that lower, and it just took quite a while for this SBF Canadian spruce market to figure that part out.
Yeah, no, and I think one of the things we'll discuss today is how do you know a market's bottomed?
Yep.
And I think there are some telltale signs to look for, with open interest, with the CFTC numbers, with the spread structure, the fundamental technical perspective, all of the above. But we'll go over that kind of later in the podcast. I figure we'll just start with the usual and then
Yeah,
work
and
into lumber.
the reason I was late is I put together a couple of slides for things that I look at in chart patterns um, to indicate a bottom as well.
Yeah,
So
good.
we'll wrap those all up. So let's kick it off.
All right,
Here we go, Greg Kuda.
All right, welcome to the weekly podcast. We'll start with the usual comparison of the equity markets, lumber, 10-year notes, and crude. And, the two things that stand out here is crude oil continues to ratchet higher. And the 10, and lumber continues to ratchet lower. When you look at equities, the 10-year, they've kind of are stuck in their recent trading ranges. So like kind of flipping here. Here's a front month continuation, daily continuation chart for crude oil. And again, this is WTI, Western Texas Intermediary Texas crude oil. The path is still higher. Pure and simple. Amazingly enough, we continue to push where we're back in this 120 area. And technically speaking, there's a strong indication until technically you would see some kind of definitive close back under the 9-day, which is this blue line here, or this coil triangle formation. Until you would get a convincing technical reversal here, the path of least resistance continues to push higher. One of the things we haven't looked at, and this is something that I look at for sawmills as far as doing energy hedging, this is a 2022 crude oil calendar stripe. And so basically what this is this is just taking a 12-month average, and these averages can be January through December. They can be July through August. You can kind of determine when you want to start this and when you want to end this, but this is just a 12-month average of crude oil. So when you look at crude oil prices for the remainder of 2022, the average price, so front month crude is $120. Average price for 2022 is 113. If I go out to next year, 2023, it's up at $96. So you could see, even as you go along the price curve, and with crude oil, you can go years out. It's not like lumber where you're just stuck, a year out or 9 months out. You can see when you look at average prices for crude oil next year, you're already at $96. So, again, signs that inflation is abating. It's certainly not evident in crude oil and energy prices. If I flip, here's RBOB. So these are RBOB front month futures. RBOB
RBOB
is
gasoline.
basically your unleaded, unleaded gasoline. So your kind of industry cost is about just over $4.10. And then when you look at, here's Department of Energy retail prices, you can you can see, and this is as of I want to say this is as of last week. I know at the pump here we're above $5 finally. I know as you go further west, you obviously stair step into that $6-7 area. But again, there's certainly no sign that energy prices are rolling over from a spread structure, from a continuation structure. When you look at the inversion of these curves, the path of least resistance until you get demand destruction is higher highs.
All right. So, I got to tell you, lumber taught me something in that move to 1700. The unprecedented, never been there before. I was certain that as we approached $1,000, we were going to have massive demand destruction. But the reality was it didn't. And when you really consider, great, these prices are higher, but are we still not going to travel? No, you have to get to work, right? People are still going to get to work. Maybe on the weekends they might do a little less, but they're still traveling.
Yeah, and so here's that stripe, the same stripe for RBOB, and so who looks at this stuff? Well, if I'm a retail yard or a retail, I've got, let's say, 4 or 5 yards in a geographical swath. I probably have my own trucking fleet. I'm going to consume either diesel or unleaded. I'm going to use heating oil to run facilities. I'm going to use natural gas. I'm going to use something energy-wise, unless I'm biofuel. And this is kind of where it's a lot easier for sawmills, for end user types to fix their cost. And this is how you would fix cost in the energy markets, whether you're talking natural gas, heating oil, RBOB, or crude oil, which is the aggregate of basically you crack crude oil to get heating oil and RBOB. So this is something where even if I look at the RBOB, the unleaded gas for the remainder of the year, your cost is somewhere around 360. And so you basically can, the upcharge on this is somewhere around 80 cents to $1 to the end user. So again, the path of least resistance continues to push higher. So at the very least, you want to see some kind of technical correction back under these 9-day moving averages to suggest that we're done going higher. But right now, you're moving higher, and this kind of boils into, here the last 5 days since our last call, Mike, biggest winners are obviously natural gas, heating oil, there's crude oil, there's unleaded gas. You can see soybeans are here, oats are here. Again, physical commodities run this list right now over the last 5 days. Who are the biggest losers over the last 5 days? Here she is down here, lumber. So lumber, that leading indicator, is the leading indicator to the downside. We'll see if that, how that spills over into other physical commodities. If this is truly a leading indicator and you get the spillover effect in the next, let's say month to 3 months, if lumber's true to form, then these other commodities should begin to suggest some kind of topping formation. And the whole reason I bring this up, we'll roll into equities. Here's equities as of the end of May. You can see the Dow was down year to date 9%, S&P down 13%, NASDAQ down 22%. So you did recover from the low water mark beginning of the month. Look at the big winner here. Crude oil is up 52% year to date. And then you've got Bitcoin, and lumber is kind of in between, just in this Bitcoin area where it's the big loser here year to date relative to the other commodities. Here's an interesting chart. Here is the May. This is just the month of May. This is the S&P 500, the mini S&P. A lot of crazy volatility, a high of 4,300. The lows somewhere in this 3850 area, and basically you almost settled unchanged for the month of May. So the volatility has crept into these other markets, equity markets, the S&P especially.
There's people trying to figure it out. There's a lot of uncertainty, and how this inflation game is going to play out. On the radio in this morning, I heard someone bring back up the term transitory inflation. I mean, some people had thrown the idea that we were just a temporary inflation out the window and this was going to be permanent for a while. And the guy on the radio was talking transitory still.
Yeah, and so I guess my whole point is, okay, so your free money's been taken off. The Fed's got to rein in their balance sheet. Free money obviously fueled the run in the S&P, and that's what you see with this white line is, or I'm sorry, the pink line is the S&P, the white line is the Fed pumping money, liquidity into the economy here. So as you start to rein this in, when I look at equities, I look at the energy markets, something's got to give. One is going to call the other one out here in that I find it hard to believe that if you're going to continue to stair step higher with consumer cost of energy, whether it's unleaded, heating your house, a lot of people use natural gas versus electricity to cool their homes. At some point, either if crude oil is meant to continue to stair step higher, then I think that definitely portends lower lows in the equity markets, and that I think you're going to figure out demand destruction here a lot sooner with crude oil continuing to trend higher. The more that continues to trend higher, I think you're going to reach that saturation point as far as demand. So either energies is going to call out equities or vice versa, but I don't think you can have it both ways, in that it's going to be very difficult to right the ship in equities with energies continuing to plow higher here.
It makes life more expensive. That is for sure.
We'll run through this. So I thought this was interesting. This is equity mutual funds. You see total equity funds, equity mutual funds, equity ETFs, and you can see for April, look at the net flow. You finally started to see with the bigger corrective move in equities, a negative net inflow, meaning there's more outflows than inflows into equities right now. So the idea that equities are going to bottom, you'd want to see that with a positive increase in these inflows into the equity markets, and we're just not seeing that right now. We looked at this last week. I wanted to jump into inflation. So here was global inflation. The U.S. was kind of neck and neck with the UK, up over 8%, 8.5%, 9% with inflation, CPI, PPI. I thought this was a great chart by Yahoo Finance. So where inflation is and isn't over a 12-month change. And so the obvious ones are gasoline, airfare, used vehicles, transportation, hotel rooms. And I've flown, interestingly enough, I've flown 4 times since the end of March. And I'm looking to book a flight to go to Portland the end of this month, and to fly with a connection, it's over $1,000 now, which is just mind-boggling. So you wonder with this travel element, just the cost of hotel rooms, the cost of gasoline, airfare. Again, what's the breaking point for consumers here? Because stuff is definitely more expensive, and where this leads to is here's average hourly earnings for private sector employees. So we just looked at inflation, and inflation is running around 8.5% to 10%, depending on where you look at. When you look at all employees, so this includes managerial, executive, you can see that wage growth is somewhere around 5%. If you're willing to move, you're an hourly employee that can jump job to job, you're definitely you're the biggest beneficiary of finding actual wage growth to mimic inflation. But the average salaried employee is lagging woefully behind where inflation is. So what's the breaking point here? And that's the $1 million question. At what point do you get demand destruction because of inflation? Because wage pace is certainly not keeping up with where inflation is running right now.
No, that is that is true. Actually, I just talked to a friend whose son is a umpire, and he was going to travel to go umpire a game and get $65 to do this. It was going to cost him $40 worth of gasoline to get there.
Yeah, no, I mean, I'm kind of on a board of a local recreational baseball league here where I live, and we have a massive umpire shortage where we're having to pay at a minimum 50% more to get people to come out, and the usual suspects that would umpire in the past, and I'm talking high school accredited umpires, they don't exist. I mean, there are games where you're supposed to have two umpires, you get one umpire, or you don't get any umpires, and coaches have to kind of take over to where and again, this kind of jumps into, so here's your job openings versus unemployed but seeking work. There's still a significant amount of job openings relative to being able to fill these holes.
Yep.
You're starting to see a little bit of convergence, but not obviously there are still significantly more job openings for those that are available to do work or want to do work.
I'm a believer that we can import some deflation, meaning let's get some more people in this country to work.
Yep, absolutely.
But all right, let's move on to lumber.
Let's go. We'll jump through. So just lumber. Let's get into housing. I thought this was interesting. Here's mortgage rates over the last 5 decades. So how does this year compare so far with previous decades? And let's hope that we mimic 1990 versus 1999 versus mimicking 71 through 79, where right now, you're at a high water mark from an interest rate increase standpoint. Let's hope this begins to moderate and at least go sideways. So flip to, this is a great, this is NHAB. It just speaks for itself. Like again, you can see. I don't know if you could see this, but a year ago, 25% of new home sales were priced just below $300,000. In April, this accounted for just 10%. So there's your housing inflation, where
Right.
it's a significant change year over year. Another person I would definitely Len Kiefer. He's another guy I would definitely recommend following, but he prices mortgage payments, interest rates, and loan size. And you can see how 2022 is a is a big red flag here, how it stands out relative to the previous year. It's going back
That's
to
an amazing
2000.
chart. And
Yeah.
So you understand what you're looking at here. On the far left, at a 2% mortgage rate, your monthly payment, being $1,000 up to $2,750, what you can afford for a loan. So at 2%, you're up at $800,000 almost. At 9%, you're at $350,000. So the deterioration in the pricing power of your loan payment is significant as mortgage rates move higher. So, consider where, that 2022 mark, we're at 5.5%. A $2,000 mortgage or $2,000 a month mortgage went from buying a $500,000 house to going down to a $350,000 house.
Yeah. No, and the one thing I do have on occasion, everything you present is so negative, and I love news, I love facts and figures, especially when it's vetted out from reliable sources. And the difficulty is to find good news. It's tough to find. This is the stuff that's in the headlines day after day after day. And so as much as we want to put a silver lining on all this, it's difficult to do that right now, because all the numbers out there, especially when it comes to housing, certainly don't bode well as we progress through this year.
And I mean, I'll jump on your bandwagon a little bit. This morning on the Today Show, they talked about monkeypox, which affects like no one, right? Then all of a sudden I'm walking out the door. They were talking about shark attacks. It's the time of the year for shark attacks. Like, the chance of you getting attacked by a shark, especially in Chicago, is pretty low. So there is some sensationalism.
Yeah, absolutely.
I look at this. The reason we have inflation is because there's a lot of money sloshing around. People's bank accounts look pretty darn good. Are we in 2008? No, the mortgages are pretty darn solid out there.
So I'm going to skip over this. I mean, again, the one positive thing to keep us going here is record homes under construction, houses under construction at a record high. So again, these are houses that have started that have to be completed. So there's a lot of work in the pipeline that will carry us for months to come based upon we know, homes completed versus housing starts, building permits, somewhere in between.
Oh, we lost you. Yeah, and I'll pick up where he's dropped off. If let's just say homes under construction pulled back to 1.2, we're still above the norm. We're still above the long-term average on this chart. So I think you're correct, Greg, in we need to take everything.
My headphones just cut out. Can you hear me?
Yeah, you're kind of muffled right now.
Okay, hang on. Let me see what happened here.
I think you have to take everything with a grain of salt with all of this.
No, absolutely.
Yeah, I think the microphone is not coming through the headphones. I think it's coming through somewhere else.
Hang on.
Maybe on your laptop or something.
Yeah.
So yeah, look, we could pull back to 1.2, and I honestly think we will. I think that the slowdown right now is going to be good. It's going to allow everyone to catch up and finish off some homes that may have been waiting for Windows appliances or something of that nature. All right, we bounce to the next chart there.
Yeah, so let's.
You're back. You're good now.
Okay, good. Yeah, it kicked off for no reason. Anybody that wants these slides, obviously I'll send them out. There's just a lot of good. I don't need to dwell on it, but you kind of said people were flush with their cash. And this kind of was a headline on CNBC yesterday. So this kind of speaks for itself. So the collective amount of money mortgage holders could pull out of their homes while retaining 20% equity rose by an unprecedented 1.2 trillion in the first quarter of this year. Equity stood, so-called tappable equity stood at 11 trillion, or 2 times the previous peak in 2006. So again, that just speaks volumes. Those that have had home ownership have benefited significantly and have a lot of money based upon just valuations right now tied up in their homes. So that's another cash cow where you can take money out of your house and survive if needed because the equity is there.
Perfect. All right, let's get to some statistics about lumber. There we go.
So since the high on March 4th, the 1477 front month futures, and this is as of this morning, we made a new low in July, 585.40. We're down just over 60% off of that peak. Since making an attempted reversal at 7:15 on Friday, 527. This was the Friday before U.S. Memorial Day. The contract is down 18.1% in the last 6 trading days. Total open interest since peaking is down 18%. The July SEP spread peaked out at 119.70. So we've seen a correction of 116%. We've gone from that contango structure to the inverted structure to we've gone from an inverted structure to a contango carry structure. So and literally in the last month, we've gone from a bull market structure to a bear market structure. So one of the things that we'll jump into, we'll run through some things, but just characteristics of what to look for a market that's bottoming.
Yep.
Here's weekly continuation. And Mike, I don't know, you had charts. I don't know if you want to pull anything up, but
no, mine are just chart patterns.
Okay. So the weekly portends this upsloping trend line here is somewhere in the again, this 590 is current. It puts you somewhere in this 550 to 525 area, depending on what time frame you look at. And then here's a July daily chart. So this swing objective here, if you take this high to this low, this high would portend a low somewhere in this 550 area. That's also a Bollinger Band low. So again, technically speaking, it suggests that the lows should be somewhere in the 550 to 5.25 area. Again, the one thing I want to stress, we'll get into this, the idea of using technical numbers to pick bottoms is a thankless job, in that you typically don't realize that the technical number is of significance until after the fact. It's not a forward thing, it's a backward looking indicator, in that, oh yeah, this was the low, this makes sense. Anything within 2 to 5% of technical numbers is probably good enough if you're going to try to use those to pick bottoms and tops.
One of the things I think is important to look at is the basis trade is back almost in vogue. What was it, just a month and a half ago? We were talking about don't buy wood, buy futures. Now we're getting to that time when, hey, maybe you buy wood and sell futures. That definitely lends support to a cash market when you can hedge an inventory.
No, and that's kind of the whole, when you look at this carry structure now, especially in SEP and NOV, as you stair step higher, where July right now is 604.50, September's in the 617 area, November's in the 621.80 area. If I can buy 6-inch sub 450 today or 4.25, then September probably becomes a basis opportunity. If you see downside risk, so here's the other part of using technical indicators versus fundamental indicators. Investment levels and physical cash, to each his own. What species do you trade? What item do you trade? You have to look at the correlation studies. Do you want to look at 3-year averages, 5-year averages, 10-year averages? Do you want to look at seasonal averages? Do you want to look at relationships between 4-inch and 6-inch? All these things need to be baked into the cake as far as what's the downside risk? Do you need to basis trade at the low end of a perceived move? And the answer isn't always, yeah, you need to basis trade. There might be instances where you can just buy the physical wood and buy a put. You don't necessarily have to sell futures, because when a market does bottom, you're likely going to see the bottom initiated first in futures, where futures takes off to the upside and cash kind of drags behind. So these are some of the things when looking for looking for a bottom, whether it's a bull or bear market structure. I think it's critical to look at a kind of a bevy of information. But as much as I want to just look at technical numbers, I think the fundamental perspective is huge. And when we get into the other things I want to point out here is open interest, and open interest is 2291 down 32. So when I look at the CFTC numbers, Mike, what are the things that stand out here? Managed money. There are no official commodity fund longs in this market. They've all been pushed to the sidelines here.
Wow.
You continue to see a build in the momentum trade. So the managed money, lower lows, is triggering new selling. Okay. The other big thing that stands out here, your commercial position, both long and shorts, continue to liquidate. Longs are liquidating for the simple reason that you've had convergence. You've had basis convergence between cash and futures. So if you can go buy the physical cash, you're releasing your futures position, you're buying the physical cash. Shorts are in the profit taking mode, where whatever they have to sell the physical cash at, it's probably been made up with the futures position. So they're just in liquidation mode. So what I'm looking for here to kind of show that a bottom is in place, all bull markets start with the short covering rally. What's the obvious one where you could get the short covering rally? It's right here. This is your last in, first out crowd. This is your LIFO momentum trading crowd. So when the momentum ultimately stalls to the downside, you stop making lower lows. On any up move, a day, 2 days, you get back above the 9-day or 20. Oh, sorry, you get back above the 9-day moving average or the 20-day moving average. This is the crowd that can get pushed out first. So you might not necessarily see an initial build in open interest, but you will see this shift. This will go down. This potentially increases. More importantly, you start to get the commercial side of the equation starts to increase. You get new longs that come into the market that think we've bottomed. And you also see a build in this short position because you're in a carry structure. So sawmills on a bigger rally in September, on a bigger rally in November. Let's say you get September back to 650 to 700, November back to 650 to 700. The sawmills will start to sell this. If they're EFPing in July, any bigger rally where you trade at a premium to where they're selling physical cash can bring on new selling too. So again, what I'm looking for a sign that the market's bottomed, when I look at open interest in the CFTC numbers, these guys get run out of the market and this position starts to increase on chasing momentum higher.
All right,
Those
so
are huge things.
What I talk about later, I want everybody to remember this 449 position.
Yeah, absolutely.
So let's bump to the next. I think we'll probably not much to talk about in the basis.
No, so I don't even have the basis charts. And the one thing I wanted to stress with, the idea we've gone from a inverted market, a bull market, to a carry market, a bear market structure. So lumber future spreads have been leading indicators to the downside. You saw this carry structure develop first in lumber spreads, where that July SEP spread was trading $100 over. It went to 20 under. So the spreads are leading indicators. As those spreads start to erode, that's a good indicator of what lies ahead. And more importantly, front month should act like a front month. Well, in trying to pick a bottom, July's been disappointing, where it's been losing relative to the back months here. But as far as telling you from a directional standpoint, July's been doing what it should do here. July's been leading the charge to the downside relative to September, relative to November. So what's another sign that the market's bottoming? You get a day where July builds open interest or doesn't lose open interest, and July leads the charge to the upside relative to September and November. You get a day where that July SEP spread narrows and July is the trigger to the upside.
You got to be careful, but right now we have to be careful watching July because it is the waning contract.
But it's the waning contract, but from an open interest standpoint, it still has the biggest open interest.
Of course.
So
like today, if this happens today, absolutely. If this happens on June 29th, I'm getting a little.
And so, for me, when September overtakes July, then that becomes the relevant contract to be the leader, to the upside or the downside. So, those are the things that I'm looking at from a fundamental, from a technical standpoint, as far as, a market bottoming. And the reality is, you've got to take all these things and add them up. And when you get 3 out of 5 or 4 out of 7, 5 out of 7, then that's a pretty good indicator that the market's in a bottoming position. I'm hearing cash in the I'm hearing cash in the 570-ish type area. So you could make the case that futures is at a premium right now to physical cash.
Cool. So let's just, we're getting a little long here on time. Let's jump over to this, what I want to talk about, which is chart patterns. Unless, is that, you got everything covered?
Yeah, all good. Yeah, no, I'm done. I didn't even do the basis because I figured there's just a lot of stuff to cover.
So we're talking about bottoms in markets. And I think it's really important to look at charts for sure. They definitely have a lot to tell you. The first thing I want to say is there's trends, uptrends, downtrends, and the classic chart pattern in an uptrend, they call higher highs, higher lows. It looks like, a sawtooth pattern moving higher where the low point of every move stays higher than the previous low point. And this, same for a downtrend, lower lows, lower highs. The catch on this is a sideways one, where all of a sudden you're not making lower lows, you're not making lower highs, or you have a failure, lower low or higher high, higher low, and then all of a sudden it breaks back down, but it doesn't take out the next low. So you got to be careful of the sideways movement. So let's just take a look at, this is from barchart.com. This is lumber, front month lumber on a daily. The reason I have it on a daily right now is there's a lot of noise in long-term charts when you look at them too precisely. And, specifically, if we look at this area right here, which was last fall, it looks as though we have a right here, a lower high and a lower low. And you could make the argument, and I think it would have been easy to get caught in this, that, okay, the market rolled over. But when I change this to a weekly nearby, and it smooths things out, you can see where, okay, higher high, or first thing we did right here, we made a higher low. Now we've got a higher high and another higher low. And from this pattern right here, we broke out to the upside. What I can tell you is the commodity funds are looking at these charts from a weekly basis. They're not going to get shook out on a daily basis.
No, and I think one of the things that I look at, and I look at the CFTC numbers for all commodities or commodities that I trade, and then I try to relate those numbers to the actual weekly continuation charts. And I think one of the most important weekly moving averages is a 40-day and a 44-week moving average. Those have a tendency historically to trigger big moves by commodity funds in and out of positions. And I think the same applies for lumber. But I think the weekly chart is definitely more relevant from a commodity fund's perspective, because usually they're looking for longevity in their trades, where they're looking for some kind of momentous. They're not looking. Typically, the algos are different than commodity funds, but commodity funds are looking to build basket of good positions that have more longevity, staying power, and so they're more inclined to look at those monthly and weekly charts than to get overworked by the daily or an intraday chart. That's more of your day trader, algo type trading than position type trading.
Sure. So the first thing I look for is breaking the trend. No longer are you doing higher highs, higher lows. The next thing I look for is, okay, did that happen on a double bottom? Let me slide this over. A double bottom or a double top. And there's some really great examples on this chart on the left, which is, this is the actual lumber chart. I would call this right here pretty much a double bottom. You've got, what is that price is around 450, and this price right over here was around 458. So the chart made a significant double bottom and then had a higher high, higher low, and it broke out of there.
Mike, I'm sorry. What time frame is this?
This is weekly.
Yeah. And all I would say on the weekly and monthly charts, on the weekly, a 2% deviation is usually good enough. On a monthly, I'd be anywhere from 2 to 5%. That you to get within $1 or such a small, depending on what you're trading, 2 to 5% is good enough, and I think that's how the funds see it as well.
So now we can look up here. While this isn't a perfect double top, it turned out to be a pretty significant double top, obviously, where we rolled over. If I slide this chart over and I just showed you that, you'd be pretty bullish on that, on this day right here, or this week. You'd be pretty bullish because we've got a higher low, and I should say that this higher high here would have given me some pause, but we broke out.
So Mike, slide that over. The one thing I want to point out, so you made that a higher high here. So the other thing you have to look at here is the change in open interest, where was this new buying or was this running stops? And if this is followed by new buying, then that higher high can have the momentum trade, the commodity fund type trading to push a market higher. But if you're just running stops, so think about everybody that sold this market and they're using the old high as a stop area. Without that new buying to come in here, you just gun the stops out of the market. There's zero buying to support this breakout higher. So the immediate reversal back to the downside. This is why when you look at the technical charts, it's critical to incorporate the open interest, the daily volume, the CFTC numbers to see who's in this market and who has the ability to push, because size matters when it comes to trading. And commodity funds, especially in a market like lumber, A full allocation in lumber could easily be a limit position, and it doesn't even, they don't even bat an eye where they, you're only going to be as big as the given market you trade, but commodity funds have those deep, deep pockets. So I think when you look at the higher high or failure to make a new high or low, it's critical to look at what are the commodity funds doing. And so I don't know if you can switch back to my chart here.
Well, here, let's. You brought up a great point, and by the way, looking back at charts, hindsight's always 2020. It looks so easy.
We'd all be multi-millionaires if we could trade the left side of the charts, right?
Sure. So I'm going to look at three things right here at this point. What Greg just talked about. If you look, this is open interest. Open interest build on these 3 weeks. Or these 2 weeks when we did not make a higher high. So you've got a lower high, a lower low. That breaks the trend. You've also got a build in open interest, which says smart money is saying, it's time to get into market here. Wow. It did eventually squeeze a little bit here. We probably tripped some stops. We really created a double top. So what I'm saying is when you got over to this point, actually probably this day right here. So the beginning of March, that's basically when the market really started to turn. Of course, you can look back and say, all right, we've kind of got a double top. We've got some, lower highs, lower lows, and we built some open interest on those days. So that's 3 indicators that say maybe we've put a top in. All right. So let's fast forward to today. Obviously, from a weekly standpoint, there's nothing to tell me that we have a bottom in from a technical standpoint, but I'm definitely have my ears perked up because we're entering this double bottom area here, which is a level of support. We have a very mature move, meaning in time frame, it's gone down. So I'm going to start looking for builds in open interest, which I'm not sure what these numbers look wrong, but I think if we could see a build in open interest here, which would show new interest in getting into the market. If we pulled back and made a higher high and then fell back down and didn't take out that low, I would really be interested. And we kind of have a double bottom going on right here. So there's the makings for a bottom in place. By no means has it happened from a technical standpoint. And I just want to point out, going back to that 449 short position by managed money, they're going to get out when when the chart makes a pattern like this. When they get a higher high, higher low on the breakout, they will cover their position.
Yeah, no, and Mike, can you go back to my screen? I'll just show
Sure.
one thing. I know we're pushing up against it early, but so one of the big things when you look at the open interest on this weakness lower, that commodity fund selling with July leading the charge to the downside is materializing in July. So we know at the very least by the end of this month, because they're not going to be in a spot month. And, how do we know that? Go look at a commodity fund's prospectus. They'll tell you exactly how and when they roll in a deliverable contract, because legally they have to divulge that to their investors. But the point is here, what I'd be looking for is an outside reversal day where you made a lower low today. If you could close above yesterday's high, if you could close above the 9-day, that would be a good indicator you're trying to bottom out. That's the daily. If I go back to the weekly, again, you'd want to see some reversal back above this, this current week's high. They don't have the indicators on here, but you could see stochastically RSI, we're starting to get overdone now. When I look at the, this is the other thing I referenced. Here's that July SEP spread. Okay. I want to see this stay above I want to see a reversal now in this spread where, again, knowing that these guys have to roll their short position, this spread could easily go back to even money, could easily go back to 20 to 30 over, not necessarily with the change in the market structure. It could have everything to do with the commodity funds knowing that as we get further along into June, that they have to roll their short position into September. They're either going to have to liquidate that short position or they're going to have to roll it into September. To liquidate, the reality is if this market continues to push lower, they're probably going to roll. If the market reverses higher, then that's probably where you would get that liquidation, just exit stage left, take the money out of the trade. On weakness in a carry structure, funds are more inclined to roll their position. Why? Because they're getting paid to do it.
Yep. So, going back to what should you do if you're not trading futures, if you're in the cash market? Well, futures is telling you that it's fair value to buy cash right now. There's no advantage buying futures. So that's another indicator that we could be potentially setting in a bit of a bottom here.
Yeah, and so the other thing I'll point out, for those that are long July, it's offsides. You still want that convergence to take place on your end, and for like an end user, there's still that 30 to 45 day lag where you might not see. Okay, we know that print tonight's probably going to be 610, sub 600. You might not see those numbers yet at the end user type level, but there's that 30 to 45 day lag where, before July goes off the board or before you get into the end of this month, you will get legitimate convergence, or within, again, that 2 to 5% threshold between July and physical cash. It just might take longer to develop for the end user type level.
Yeah. All right. Let's wrap up. Let's see what happens next week. If maybe a bottom is in place. My personal opinion is I don't think we have a bottom in place. I think there's some more liquidation of cash inventories that need to be done. But we will see.
And I would say next week we'll obviously update everything, but I think we'll continue with the technical analysis theme where we can look at Bollinger Bands, we can look at moving average, and just look at some of the other stuff that and again, I have no problem sharing any of this. There's no holy grail. As much as anybody will tell you, there's no holy grail when it comes to technical trading. It's finding out what indicators work for you, and it's usually not one. It's usually 3 to 5 that you're going to look at. When the stars align, then they become valid indicators. It's that mixture of technical and fundamental analysis, especially when it comes to lumber. And we'll definitely, I love sharing this stuff because I want people, when they look at charts, to understand what I'm looking at.
For sure. All right, everyone. Thanks. And we'll see you next Tuesday.
Thanks a lot. Take care.